Hello and welcome to this very short explanatory video on depreciation. My name is Arjun Mehta and I'm a lecturer in accounting. If you have struggled with this concept in the past, this video will surely help you. But please note that the purpose of this video is to provide a simple explanation of the concept only, and I will not go in detail with regard to accounting side of the depreciation. We'll do some basic, but not in great depth. Okay, so if you're ready, let's begin. So just to give you an overview, we will look at the meaning of depreciation first of all, followed by different types of depreciation methods, and lastly, we'll focus on how to account for it. Okay, let's start. Let's start with the definition. So what is depreciation? Well, according to a formal definition, depreciation is a systematic allocation of cost of a tangible fixed asset over its useful economic life. I know there's too much jargon in the definition. Well, it simply means that rather than treating the cost of an asset, such as building, machine, furniture, etc., as an expense and deducting it from our profit and loss statement in one go when we purchase it, we can spread that cost over its useful economic life. Okay? Because imagine how significant the losses would be if we try and deduct the cost of a fixed asset like a building in one go, right? Losses will be huge. It's not good. Okay, so what we want to do now is pick each term from the definition and understand that concept in more depth. So let's focus on the term tangible fixed assets. A tangible fixed asset, or which is also known as non-current asset, like property, plant, equipment. This type of assets are acquired by businesses with a view of using them for the business for long term. For example, a business may purchase a property for a long-term use. It might be used as a factory, an administrative building, or even a warehouse. In accounting terms, these assets will provide economic benefits to a business for a long period of time. In other words, a factory will be used for production purposes for say 20 years. So in this case, the business will get economic benefit of income and hopefully profit from the sale of goods that it produces in that factory. Okay, so that's their economic benefit provided by factory. So I hope it gave you a fair understanding of what a tangible asset is and what economic benefits are. So now let's understand what we mean by systematic allocation of the cost of the asset over useful life. So the assets we mentioned before a few seconds have fixed useful life. For example, a PC may have a life of 3 years. After 3 years, it will become redundant and you'll have to replace it. Or a building, okay, it may have a life of 50 years. After that, it will need to be demolished and new building will need to be built on that site. So for a business, the economic benefit that would continue to flow from the asset, but that will happen for a fixed period of time. Now, the cost of the asset when we spend money is often significant. For example, cost of a property could be in hundreds of thousands of pounds or even millions. For accounting purposes, businesses, rather than treating this cost as one-off expense, the cost, in fact, they spread it over the useful life of the asset. Why? Because the spreading is to match the cost of the asset with the benefits we derive from it. Okay, so let's understand this through an example. Say if the cost of a machine is £50,000 and the life of that machine is 5 years, then every year the business will derive 1 year worth of benefits from that machine. Okay, like as mentioned, production and sale and income and profit, and therefore it will charge 1 year worth of depreciation, which is £10,000 for 5 consecutive years. Okay, in 5 years time, the business will have used up all the benefits from the machine and systematically charge the entire cost of it in the financial statements, matching it against each other. Understood? So this is what we mean by systematic allocation of cost of a tangible fixed asset over its useful life. Now let's look at different types of depreciation methods. Although there are many depreciation methods, okay, we will focus on two main ones as you are more likely to encounter them during your studies. These are straight line method and the other one is known as reducing balance method. So we're going to go for the straight line method first of all. It's simple, it's easy, it's very straightforward. All we have to do is to spread the cost of an asset over its useful life in equal installments. Every year it's going to be the same, no change. But reducing balance method will charge higher amount of depreciation in earlier years of the life of an asset, and it will gradually decrease as the years progress. This method is best for assets such as machines because over time the benefits we derive from it, from the machine, the type of assets, will deteriorate. It will not be the same every year. Okay, it will go down. And to match that decline in benefits over time, we also gradually reduce the proportion of depreciation that we charge in financial statements. Okay, reducing balance. So that's a table showing you examples. One more thing, in any depreciation method, we should only spread the cost that a business has to bear with regard to an asset. So if the asset acquired has a residual value, has a second-hand value at the end of its useful life, it should be deducted from the cost of an asset while calculating the depreciation. For example, say a car that is acquired for £10,000 could be sold for £1,000 after 10 years time after its life. In this case, the annual depreciation will not be £1,000, but in fact it will be £900 after taking away the residual value. Okay, so this is how we calculate the depreciation. Now, let's look at the accounting side of it. So depreciation is an expense, although not a cash expense because no cash flow takes place when we work out depreciation. Remember, we already would have paid for the asset and the cash flow would have taken place at the start when we actually acquired the asset, when we purchased the asset. Depreciation is just the allocation of that cost. It's an accounting adjustment. It is an allocation of the cost over its life. So this expense of depreciation is deducted from statement of profit or loss as an expense. Profit goes down, and in the balance sheet or in statement of financial position, the same amount of depreciation is taken away from the value of an asset. So in the balance sheet, you keep an asset, and every year you take away the depreciation amount, and the value goes down. All right. So the amount that you find after deducting depreciation is called carrying value. Is that clear? But please note that I'm not going in more detail here because it's outside the scope. We are not talking about the debits and credits and which accounts to debit, which accounts to credit. Okay? So I hope that gave you an overview of concept of depreciation. Okay, we're just going to do a bit of recap now. Just starting with the depreciation definition to remind you. Depreciation is a systematic allocation of the cost of a tangible fixed asset over its economic useful life, and I explain each term. Straight line depreciation method equally spreads the cost of an asset over its life, whereas the reducing balance, the depreciation charge under that method will decline over time. And lastly, depreciation is an expense which is charged to statement of profit or loss and also deducted from the value of an asset in the balance sheet or statement of financial position. Okay, so I hope you enjoyed the video. If you have any questions, please feel free to reach me through the comment section. And thank you for paying attention. Take care.